I'm going to provide a bit of a financial update for everyone. I'm not going to give any forward-looking information here, but a lot of this information is historical, and I want to give a little bit of context to it. So typical kind of forward-looking statement disclosure here. We thought I'd start with our 5-year financial objectives, and we've been talking about these for a couple of months now, but I thought I'd lead with these. Really from a revenue perspective, our plan is to grow the business by 5% a year over the next 5 years. And if you step back, and lots of finance people here, the easy math is really to get the business back to $300 million in revenue. And we think that's achievable over the next 5 years. We're also putting in place plans to grow our gross margins with auspicious targets at the high end of 40% gross margin. We think 35% is certainly within reach over the next 5 years, and 40% would be a stretch target there. As you can see, and I've got a slide in a few slides here, you can see the progression in our gross margin. We've been consistently making some good progress there, and we think there's lots of opportunities on that. SG&A, our target is to continue to work hard at grinding SG&A down. We've set targets of 18 to 20% of revenue, and really part of that is going to be keeping our SG&A fairly constant or zero overhead growth as our revenue accelerates. And if those work, we should have adjusted EBITDA results in the 18 to 22% range. So really kind of top line here, the objective is to get the business back to $300 million in revenue. Got a revenue chart here which goes back a couple of years, and I think it's kind of useful to look at our revenue on a pre-COVID and then kind of a COVID period, and then what we think we're emerging from is kind of a post-COVID environment. And you can see in 2019, we really didn't impact or didn't really feel the results from COVID until the end of the first quarter of 2020, and that's when we started to see some revenue declines. We certainly did benefit in 2020 from some kind of COVID-related product sales, probably in the $7.5 million range, and that would be everything from hand sanitizer and PPE and some other kind of signage and things that maybe unusual business that's not going to return again. But certainly we're still seeing some things, and some business has shifted. Where we're looking at now, and I think if you look back over the past 5 or 6 quarters, you can see that revenue is kind of stabilized. And so we're kind of in that high 50s, kind of low $60 million range per quarter. But I think what's also informative from this is you can see on a kind of an annual basis that our revenue tends to be highest in the first quarter of the year. Second quarter is typically the slowest. Third quarter starts to rebound. Fourth quarter accelerates a bit, and then again into a stronger first quarter of the next year. We talked about our gross margin aspirations, and this chart shows our gross margins over the past number of years. And as you've seen, if you've been following us, we've been putting a lot of effort into consolidating facilities, revenue management, really trying to drive efficiencies out of our business to make our business a better business at the end of the day. There was a bit of a blip in Q4 of 2020 where we only hit a sub 25% gross margin. But if you ignore that, we've been pretty consistently in the 29 to 30% gross margin range. And that's despite some revenue declines over that period. So our view is, we're pretty consistently in that 30% range in the near term. Our plan is to grow that into the 35% range and ultimately strive for 40%. Here's a few initiatives that will help us get there in the near term. And we've talked about these before, but I wanted to highlight them. First one is digital inkjet capabilities. And we expect that we're going to save about $1 million from a couple of different initiatives related to this. One is putting in a new digital inkjet press, which we haven't had before. And this, we're frankly really excited about the revenue opportunities that this will provide us. We've got a number of jobs that have and client work that we've just not been competitive with the prior technology that we had. So we think not only is this going to open up opportunities for new work, but it's also going to increase the margins on some of the historical work that we've been doing. We've also done a bit of a refresh of our digital equipment fleet, and so all in, we expect that's going to save us about $1 million next year. The consolidation of our Mississauga and our Brampton facilities is on target. We've done, I guess, 2 waves of moves so far. Started 2 weekends ago, and we have started moving equipment over, and it's starting to light up in our new site in Brampton. Rent and overheads and a little bit of consolidation, that's going to save us about $1 million next year going forward. We think there will be significant other potential opportunities for margin enhancement as we get those 2 facilities really humming under one roof. We previously talked about our Calgary consolidation, where we moved our Edmonton site into Calgary. That was done, I think it completed the end of June this year. So on an annualized basis, that's going to result in about $750,000 of savings. We already realized about half that in the current fiscal year in 2021. And then as Richard led off the conversation with our hybrid work model and consolidation of office facilities, we're going to save about $800,000 by consolidating some of our SG&A kind of facilities. Big focus for us is really driving cash flow from operations. And year to date, we've generated a little over $20 million in cash flow. Proceeds of this, or the funding of this, is allowing us to really accelerate our debt payment. Here's a chart that shows how we compare to last year. 2019 was obviously a year that we'd rather forget about. And 2020, we really benefited from significant improvements in working capital. So that $47 million in cash flow from operations that we generated, good part of that was from just operating cash flow, but also a good part of it was from working capital improvements. We've really kept the brakes on CapEx, particularly in 2019 with our ERP launch, and then in 2020 with the COVID environment, really waiting to see how things are going to shake out. Year to date, our CapEx are about $600,000. We'll probably finish the year $1.25 million-ish or so. And again, that investment is related to the consolidation of our Brampton and Mississauga sites as we're building a clean room to operate the digital equipment that we're moving in there. Going forward, we expect CapEx to be in the $1.5 million-$2 million range. And so you can see that the business really generates a high level of free cash flow. Year to date, we're tracking around 90% free cash flow conversion. We think that's an objective that certainly bodes well for the future. I want to highlight some of the organizational effective initiatives because they certainly haven't come without a cost. But I think here's the benefits. We've taken out almost 500 employees since 2018, and that's a 34% lower headcount than we started the year with. I've shown severance payments here that have come as a result of those costs. In 2019, it was about $6.5 million. In 2020, a little lower, 5.6. Year to date, we're about 5.2, and that will certainly continue a little bit in the fourth quarter. These numbers are in our financial statements, so in the notes if you get that far into our detailed notes. But over the next 12 months, so this would be Q4 this year through Q3 next year, we've got about another $3.5 million of provisions that are planned. And then there's about $300,000 of provisions that are kind of out another year. I want to give everyone guidance that with our optimism in terms of consumer movements turning and returning to more normal, which is going to impact our revenues, we're not forecasting any significant severance costs next year. So, these numbers should hopefully stick and may see a little bit of a little bit more, but we're really expecting severance next year to be very modest. We've talked about repayment of debt being a significant priority for us, and you can see here that debt has come down over 54% since its peak in 2019. It's just about $12 million this year alone in debt repayment, so we're making some really good headway on that. Because of the improvements in cash flow and the repayment of debt, We're in a fortunate position that we've been able to refinance our more expensive Crown Capital financing, which was 12% coupon. We've been able to replace it with sub 6% coupon debt from a combination of our bank lender and Fiera Private Debt, which the bank facility closed just a couple weeks ago. The Fiera Private Debt facility is scheduled to close on December 17th. So all in, next year we'll save $1.5 million in interest expense because of this initiative. So big win for us. I think this is useful to show here kind of our current debt maturity profile. And fine print here, we'll make the slides available afterwards, but we're currently sitting about $36 million in fixed term debt. This shows, based on our amortization schedules with our various credit facilities, our debt will be fully repaid by the end of 2026. And we think that would be a great initiative. This excludes our working capital line. With our new bank facility, we have a $15 million working capital line, and that'll fluctuate, but currently it's sitting a couple $1 million drawn. It's been very consistently in kind of a cash balance to a couple $1 million drawn, depending on working capital and big payroll every couple of weeks and things like that. So we're certainly working to keep that modest and keep that low. This chart shows our principal payments that we'll be making over the next couple of years. So you can see, balance of this year, we've got just shy of $2 million of principal payments that we'll be making in the fourth quarter. Over the next 2 years, we're going to be paying down $26 million of fixed term debt alone. So that's a big number, and you can see that the principal payments as we get into 23, 24, and 25 are fairly modest. So big aggressive payments of debt in the next 2 years. Now we are starting to see some supply chain headwinds, as many companies and anyone who's a market participant has seen. The operations team and the purchasing team, SM is represented here today, and Christine, they're doing a phenomenal job of making sure that we have the supply for our customers. We're taking advantage of the opportunity to make sure that we're working very closely with our clients to make sure that we have raw material available for them when a job is coming in. In some cases, we've been able to advance some of those jobs just because they got to get paper or product right now, and they might not be able to get it in a couple of months. So that is helping us. We think as we see price increases, we'll be able to pass those price increases along to our clients. And we'll also be able to improve our margins. One of the things that we're very proud about is almost 2/3 of our business is under contract. Now, some of those contracts are different in terms of when they allow us to pass those increases on to our clients. A lot of the transactional work is very beneficial for us in that we can adjust prices right away and pass those on immediately. Some of the longer term stuff, it's a little bit more limited, but back in 2018 when we had, I think, almost 20% increases in paper, we really learned increases in the price of paper. We were able to take that learning environment to really adapt a lot of our contracts to give us better ability to pass on increases at a better rate than we historically had. So that's opportunity for us over the coming year. Really kind of three key initiatives to our financial strategy. Really focus on growing cash flow, not only as we increase our margins and generate free cash flow, but also continue to drive further improvements in working capital, and we still think there's some improvements that we can wring out of the business over the next year. We're certainly going to be spending our efforts on digital innovation, and you heard some of the things we're doing from Richard and from Shelley and Karen. Digital innovation is going to be a real focus for us over the coming year. We're going to be very, very selective in terms of some of our kind of more traditional CapEx for equipment, and it's really going to be focused on things that can help drive more revenue through our Flex platform and really more digital equipment. We're not buying any more forms presses or any labels presses. So it's really, really a focused CapEx strategy. And we're also going to be looking at opportunistically at M&A. We don't have any particular big targets in our headlights at this point. We see lots of opportunities. We're not looking to put more iron on the floor. And so acquisitions would have to be either something that could help us advance our tech enablement of our business, or something that might help us from a technology and marketing workflow. So maybe we can find a more traditional printer that has business that we could put through our marketing and technology workflow capabilities. Or it might be a small team of professional services folks that could really help us lean in hard and make really accelerate our digital technology. So we're not looking to buy kind of a traditional print business. So very, very focused on M&A opportunities. Chart here to just kind of show a little bit of relative valuation, and just kind of a summarized model here. But we're currently trading at about 3.5 times EBITDA on a trailing basis. If we look at our print comparables, they're trading around 7.5 times. So we think there's an opportunity for us, as we continue to do the things like paying down debt, growing our revenue, keeping our margin strength. We think there's an opportunity in the short term to grow into more of a kind of print market multiple. On the kind of the next couple of comparables, tech-enabled marketing workflow companies are trading about 12.5 times EBITDA. That would be really exciting to get there. But they tend to trade more on a multiple of revenue, so almost 2 times revenue. Pure digital asset management companies, right now we're trading, broadly kind of 7 to 10 times. So, as that business develops and that market really turns out, we think there's an opportunity to capture some more of that kind of markup multiple. So, kind of painting the picture for where things could go. Certainly in the short term, our focus is on, just creating value and trying to grow into a decent print multiple, but there's certainly lots of upside here as some of our digital capabilities really accelerate. So summary, why invest in DCM? Thanks everyone for coming here and having some confidence in us and seeing what we're up to. Really 3 things I want to leave you with. There's opportunities as consumer movements return to more normal levels for our revenue to continue to strengthen, for margins to continue to grow, and that should drive bottom line results. We think there's value creation opportunities as some of our tech projects really take hold, and that print first to digital first transition, I can tell you it's really happening. Listening into sales calls and listening into some of our operations calls, everyone is thinking about it, and the level of engagement is really high. So it's really exciting to see that. And then continuing to pay down debt. So we're going to keep focused on that. So those are some of the big opportunities we see ahead. In result, there's kind of 5 things that we've closed off a couple of our earnings calls with in terms of building both a better and a bigger business. And the 5 buckets are talent, and we think we've got a great team. Business intelligence, we're starting to use some of the tools we have in our new systems to really drive better insights into our business. We've got lots of operational excellence initiatives. Our client engagement levels are really high. And tech-enabled services, I think a lot of this presentation today has been focused on profiling that. So hopefully that's given you a bit of a flavor for some of the great things we're working on.